particular event, we are going to learn about the one standard deviation formula. So what does this formula says? That is our first priority to understand what is this standard deviation formula. Then we need to identify the market trend using the first standard deviation formula or one standard deviation formula. And if you wish to, you can make some intraday trades using the one standard deviation formula. This is more or less the same as the volatility if you use it for the intraday trade. How we can form option strategy using the one standard for deviation formula, that also I'll be telling you one back testing of one standard deviation formula, whether it has worked before in any of the instrument or it will work for me. What is the surety that it will work for me? For that we need to do little bit of back testing. So what this formula speaks about, that is very important. So in this formula, the expected price range of any instrument is derived from this rule, like price multiplied with the volatility multiplied with the square root of days you need to hold that instrument, entire thing divided by the square root of 365. This is called your one standard deviation formula. Why it is called one standard deviation formula? Because standard deviation is a factor wherein we used to say that in daily basis, or like you can say in a very simplest term, if I'll say that, suppose if you have three people are having height as 5 feet, one person, another person is 7 feet, another person is say 4 feet. So if I can take the mean of this or average of this, so what I have to do? I have to add 5 plus 7 plus 4 divided by 3. So this will give me 5.33 is the average or the mean. So whenever I will subtract it from each value, so here my deviation is 5 minus 0.33. So in the first data I have negative 0.33. Second data I have 7 minus 5.33. So this comes to positive 1.67. And the third data what I have here 4. So in this also if I less it, 4 minus 5.33, it comes to minus 1.33. So these deviations from the mean or the average is called known as the mean deviation. So this deviation which each data has given you from a mean position is known as a mean deviation. So similar way, different price data, whenever we take about the price data, take average and take their deviations, that factor is known as a standard deviation. So standard deviation, once you are calculating, you will get some value associated with that. Either it will be a positive divergence or it is a negative divergence or a nil divergence. But in this particular formula, we are saying that one standard deviation is considered as one, means we are saying that the deviations which is present in the data is no way going to affect the data. Based on that, we are taking the standard deviation as 1. So 1. So based on that only, we are calculating this expected price range will be price multiplied with volatility multiplied with square root of the days you need to hold that position divided by square root of 365. So I have one example here. Nifty, imagine 8475 last Friday closing. Volatility is 17.15 annual terms. What is the price range expected in the Nifty in the coming 10 days using the one standard deviation formula? So which is nothing but 8475 multiplied with 0.17. So so 0.1715 multiplied with the square root of 10, and entire thing need to be divided by 365 square root, and that is giving you 240.58. 240 points Nifty can show the oscillations based on this particular formula. For how many days? For coming 10 days. So this data we got it using the one standard deviation formula. Now question comes how we can utilize this particular data. Whether this 240.58 or round it to 241 is going to help us in any way for deriving our trend decision or trade decision or anything else. So that is what we need to do. So while initiating this particular price range, whenever we calculate this particular price range with respect to the volatility, so this gives us one very concrete evidence how much price it can move. So let me explain whether it has worked out before in any of these things. Price range I have derived, whether it has worked out. So I am just taking one simple example here for a bank nifty. Bank nifty, I have calculated, I have taken the data from 4th May to 3rd July, all open, high, low, last traded price data. I have taken bank nifty for this July series. So wherever I am finding out the high what it has made during this period of May, June and July going ongoing month, so I am finding out during this period it has made a high of 18,944 and it has made a low of 17,215. So this 17,215, if I can focus on, so this is coming on this day. On 12th June, this has given me the value of 17,215. This is the low it has made. On that particular day, if you see the volatility of that instrument, on daily basis it was working out to this value multiplied with 100. So this was the daily basis, the volatility was working out 1.59. So annual basis how much it will come? So annual basis, if I'll take it, 1.59 multiplied with square root of 365. So you'll get annual basis, we are getting some 30 point something as a volatility. So let us take for 10 days or for 5 days. So 10 days, if I wish to calculate for 10 days how much oscillations this bank nifty will give. From the low, I have taken from a low which is being recorded. I have just identified a major low from where we had a bounce back. From there only I am just calculating. You can take from any price point just to examine this formula, just to validate this formula's accuracy level. So what I am doing here, I am taking the price here multiplied with, this is in multiplication of 100, so I have divided by 100. So multiplied with, I am taking for square root of 10 days. You can take for 5 days also. So divide the entire result by square root of 365. Square root of 365. So square root of 365. So once I did it, it is telling me it has a, based on this particular volatility parameter, it has a chance to move by 868 points in the coming 10 days. So if I take the reference from here, so 17,215 added with this, or 17,215 subtracted from this, so it is telling me either it should go to 16,346. I didn't do any trend analysis, I didn't apply any of the formulas. accept this one standard deviation formula to know how accurate the one standard for deviation formula is. So for that reason only, what I did, I have just added that 868 into this one, 17,215. And same way I have subtracted 17,215 from 868 for 10 days. I repeat my word here, 10 days. 10 days. So whenever I am taking 10 days, whether it is 10 calendar days or 10 trading days, so 10 trading days or 10 calendar days, because we are multiplying it to 365 here. So definitely it should be a calendar day. So I am, so 12th June it has made this low. So maybe in the next 10 calendar days we may be getting a level of, you can say, 16,346, or we can get a level of 18,038. We didn't do any trend analysis, I again repeat, just a calculation based on that made on 12th June when the major low is being created. In the coming 10 days we are going to expect a move till 18,083, or we are going to expect a move to 16,346. This is what it has told. So 12th got added, 13th 14th is holiday, 15th it is coming. So here two holidays are there. So 1 2 3 4 5 6 6, here 2 8 2 10. So 10 days, 10th day is falling on a holiday. So look into the 12th, 22nd June, which is the 11th trading day, because 10th day was a holiday. So 3 6 and 7 days are gone for your trading days. Out of these 7 days of trading days, 4 days are holidays. This is what you got on 22nd June. During, once that recovery process has started, you have halted at different prices, you have last traded. Once you have, and you have on 22nd June you have successfully crossed that 18,083, and you have just also made to 18,400 level you have gone. So that is Fibonacci, and whenever we will apply the Fibonacci and all those principles, it can speak more clarity on that. But it has promised you a 10 days move of 868 points, and it has delivered you that same 868 points. This is what this formula told you, and this is what this formula achieved. So this is on chat, this is on record, this is not being exploited by me. And this also doesn't guarantee that all stocks, all nifty stocks, all indices throughout the world, everything will give you the same success. This doesn't guarantee that. But when we should accept a formula, if 70 to 80% of the outcome, 70 to 80% of the instrument prove that yes, this is true, then we must accept this formula. I have not used any of the trend identifying factor and other things. I just took that formula, added it, given you the result. Same way you can see that when that high is being made, 18,900 and something, it could have been made somewhere when this high is being made, and from there also you can derive, and you can take many number of instrument and see that whether 70 to 80% of cases this particular formula works or not. So when this formula, if it works for 70 to 80% of cases, then there is a strong conviction should be there in our mind to accept it. So this is what I have shown you. So this is what we have taken. Friday's one price point I have taken, I have just told you on this order also. Now coming to the next part of my presentation, wherein I'll tell you how you can now identify the trends using this particular formula. So you got a price range. So once you get a price range, you can use the Fibonacci ratio 0.236, 0.38 to zero point 0.5. So these things or Elliott or different Gann methods. So main objective of this identifying the trend, what are the things you want to identify? Uptrend or downtrend starting point from where I'll get a confirmation of a uptrend or downtrend. Second, uptrend and downtrend reversal point, at which point if the trend sets in where we have a maximum probability of a reversal, means that trend will reverse from there. If it doesn't reverse and if it still continues, so that reversal is very much essential. So if we are in a part profit, we can hedge our profit or we can book a part profit. For that reason only we require that reversal points. Every method has its own way to find out these reversal points. Third, uptrend and downtrend saturation points, where these trends will saturate. So these things I am just going to explain in terms of a Fibonacci. So if you are a user of our Fibonacci course, you'll be knowing that in my Fibonacci book as well as in the Fibonacci DVDs, I have well explained these concepts. So here, similar way, if you are using our Gann book also or Gann courses also, that or there also I have explained this concept. So trend confirmations. Trend confirmation, same reference point I have taken 8475. 10 days we are expecting 241 point Nifty should move. Using the Fibonacci 0.236 retracement means 8475 added with 0.236 multiplied into 241, it is telling me that 8431.87. So 8431. I think I made a mistake. So it will be 241 multiplied with 0.236, it is coming to 56 points added with 8475. So this is saying 8531. So 8531. So this is the 8531. So 8531.87. So this is the price point at which your uptrend will get confirmed. Similar way, if your reference point is same 8475 and you are correcting by 0.236 times of 241, so 8418 level your downtrend will be get confirmed. This is as per the Fibonacci rule. So same rule will not be hold good for all other things. Maybe Elliott will be giving a different result. Maybe Gann will be giving you a different result. Now with the same process of this 8475, where we should say downtrend reversal point. Fibonacci says that your 0.618 retracement, 0.618 retracement to 0.786. 0.786 retracement is a death zone or the reversal point. You achieve certain trend, you have gone and you have a chances to retrace back. So based on this reference point of Nifty, it is telling that 8664 or 8285, either side when you get a trend reversal, so you can have a maximum probability to reverse the trend. So whenever you are expecting a reversal trend, what you should do? Suppose if you have bought at 8531, imagine you have bought at 8531, you sold at 8, you can sell it at 8418 also. So our argument should not be written whether you buy or sell. Our argument is I bought at 8531.87 or round it to 8532 and it has touched this 8664. What I should do? I knew as per the Fibonacci there is a trend uptrend reversal point is sitting here. So I can either hedge my profitable trade with a put option or I can go for a partial profit booking at this particular point also. Partial profit booking, or I can think of selling a call option at this particular moment. So somehow I have to protect my profit. That should be the objective of identifying this reversal point. Suppose if this reversal point doesn't come true and the trend continues, then it can have a chances of 1.618 retracement level. So it can give you Nifty at 8865 or downtrend level of 8086. So anything comes true, based on that, it can have a move. So this is how you should use the one standard deviation formula's price range for taking your trade decisions. You can the next part. So moving to the next, how to identify intraday trade using the one standard deviation formula. How you can utilize this thing for intraday trade. As for the intraday trade, whenever you are using, you need to derive the price range. I have the way I have just multiplied with the Nifty 8,475 and other things. Same way you have to take from the opening price. And instead of volatility, take the IV of the just in the money call option. So just in the money call option, suppose Nifty is at 8475 Nifty is trading. So your just in the money call option will be 8450 strike, 8450 strike, 8450 strike, or you can say 8500 strike put option. So whichever the just in the money call option or in the money put options, IV, any one IV you take, or you can take the average of that IV. Means you can take 805 8450 8450 call options IV, and same time you can take 8500 put options IV, take their average. So whatever is coming out, that you can take into account. So once you'll take that, multiply the opening price with the IV or the volatility and divide the result with the square root of 365, so that you can get the price range. Why I have taken the IV? Why not the volatility? Wherever IV is not available, you have no other choice, so you have to take the volatility. So IV of a option or implied volatility of a option is nothing but the volatility what the traders wants to give to that instrument. It is not a statistically derived. So it is trader, what traders are, majority of the traders are sensing from the market, and based on that how much they want to give the volatility today to that particular instrument. So that is much more accurate as compared to your statistical volatility calculation. So once you do that, then you have to apply the Gann, Elliott and other principle, so that based on that principle you can just make a trade decision. So once you do, then you have a choice whether I will use Fibonacci or use Gann or use Elliott or use any of the special principle, any principle you use. So nothing, no restrictions in that, but you must use a principle. That should be the thought of your trading. So you must not ignore the principle, you must use your principle. You must use the principle, you should not ignore the principle. Suppose if you are using multiple principle, volatility, Fibonacci, this that, so the new tool what means the existing tool what people are having, our traders, and we are going to upgrade those things to our integrated. So here you will get out of those all 8 or 9 outcome what we have taken, 6 are recommending to buy, 0 is recommending to sell, 2 are neutral. So based on this view you will get that yes, so majority of this are recommending to buy, I should buy. Then you should follow any of the level. So then based on that level you should take your call. So that should be your thought of your trading. So IV is nothing but, Mr. Muthuraman sir, it is known as implied volatility. Option strategies based on this particular method. Based on this particular method, how option strategies can be formed. Imagine this last example. Last example you just see. This is the 10 days I am expecting the Bank Nifty 22nd June. It has gone to, sorry, it has 12th June. 12th June it made a low, and from there I am watching, I found out that yes, 10 days it is going to cross 18,000. Now at 17,200. One major low is being created. Before that some downtrend days was there. All these things was okay. So now Question is how I can utilize these things as a option strategy. So now what I'll do, it's a very simplest trick. If you little bit concentrate, you can make excellent money out of this thing. I will show you a proof that how based on this only I have formed a strategy and given to you in last month, and you made a windfall profit out of that. So this say 868 multiplied with 0.236, how much it is coming? 200 points. This 200 points I need to add it from here. So once the price is moving, concentrate here. Once the price is moving above 17,400, my trend will be up. Same way, from now, from the 17,200 is a major low, it is being created. Once this price is falling to 17,000, my trend will be down. So it made a low, which I am observing for a couple of days. I am an active trader. I am saying that market is falling. It has come down to a low it has created, which is never being expected by me, or a high is being created, which was never being expected by me. So this low is created. Post this low is created, I took the reading. I calculated 17,400 and 17,010 is the turning point of my this particular move. If it crosses 17,400, then definitely it is turning to be a positive outcome for this particular counter for the next 10 days period. It has the potentiality to touch 18,083. If it fail and touches 17,000, then it has all probability to fall down to 16,360. So considering these two facts into your hand, or considering these two facts, you look into all moving average, this that, if you want you can look it, because it will just more puzzle it can add to you, but it won't. Look into this particular fact. If you are just doing a thing that say I'm selling future at 17,419, along with that I am buying some 18,000, because I know that it is going to be, it would cross that 18,008 level. I am buying some 18,000 call option in multiple lot and making it a delta positive net delta positive strategy, or delta zero also. Why not zero? So if you make this strategy also, it can give you a very windfall profit, excellent profit it can give you. I'll show you the proof based on this particular concept, based on this particular theme, what are the strategies I have given. And if you are a Facebook member of our website, if you are visiting our Facebook, you are also getting those strategies on hand everyday basis. You'll be, or you'll be, means if you are following us in the Facebook, definitely you will be getting. So this is our Smart Finance India, facebook.com Smart Finance India. If you just type it, you are getting the access to all those strategies. And that too also, yeah, I have little bit of refining if you can do, then with the help of a option strategy software and other things. So this I have given on 16th June 2015 for the June series. Look into this particular strategy. So look into this particular strategy. So you'll come to know that how it has performed. And if you are a member of our Facebook, definitely you could have got this strategy based on this particular concept only. One standard deviation formulae including 5 days, little bit of rules and regulations enhancement in the software, it is being given to you. Nifty 8,000 call option 10 lot, which was making it to slightly delta positive to the tune of +3. If you have joined my earlier program on the delta neutral strategy rule, there I have given +3 is, it should allow 10 lots was making it +3. This is the strategy we have given. I have told you maximum loss 8,000 rupees if it falling to 7,800 level, profit 17,000 rupees if it cross to 8170 level. And this is also, this is being given on 16th 6 and 1 o'clock 13 minute. And if you are real time basis associated with us in the Facebook, then definitely you could have got these things. So this is being given on 16th. So on 16th, this is 25th. So where is the 16th? So 16th. So if you have 16th June 2015, exactly this one. Facebook has been given these things. So the same picture what you have seen there, the same thing we have also given in the Facebook, and 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 whatever it has been proved on the fourth day, though it has been, I have given it for 6 to 7 days. Fourth day, it was at a 31,000 profit. And if you are lucky enough to keep this strategy till expiry, then your profit could be amazing. It could be a windfall. So similar kind of strategy also is being given for the July on the 21st June, taking 8,800 call options along with the future. Similar strategy. There is no deviation in that. Similar strategy is being given here, and similar slight deviated strategy also is being given here for Axis Bank. It is also still open July. This two also is being given to you on July. So similar concepts are being implemented here in public forum. In public forum, nobody, no company in India, this is, I will make it as a declaration, you keep it as note, no company in India, those who provides softwares, academic stuffs as well as tips, they will never dare to put a strategy, put a plan in front of you well before and prove it after its success or its failure. This is keep it in writing. Many of you, those who are utilizing our tool also, for them, this is also a fact in front of your eyes. So whenever this is based on the same theme of your one standard deviation. Using one standard deviation, I calculated that yes, this is what we are going to scale. Based on this scaling factor, when the trend is going to give me a confirmation, and based on that trend confirmation point, I have formed a strategy given to you, and I am projecting the profit only till the second part, where it is what I am naming as trend reversal point. If that trend reversal point, I have always given that, that's be safe. If there is a profit, you come and take these things. So till trend reversal point, I have given that profit projection. And if you are fortunate enough and the trend matures, goes to a maturity point, then you made a windfall. And it is also open declaration, and it is a fact, and it is my pride to be in the smart finance to tell you, to all my buyers, to all my well wishers, to all my users of my software, nobody in India gives you a concept in front of you with the facts, with the formulas, with the calculations in front of you, and form a strategy, gives you and show the success or failure right in front of you with so daringless as smart finance does. Because none of our stops are being copied, none of our stops are being taken from somebody else, and none of our stops are non-scientific in nature. Whichever the stops is non-scientific, gives less accuracy level less than 75%, we just discard that stops. We never integrate those stops in our software programs, or I never promote those concepts in any of my seminar events. Fine. So this is a concept you have learned, very small formula, very powerful formula. You have also seen how this kind of things, and also I have Backtesting is in front of you. Same, those who have joined earlier programs, you have almost got those things here. One standard deviation formula I have used in the 12th June. I have shown you that 22nd June what happened. So if you put it the 1.618 retracement, see the magic of this particular method. So though I have not worked out in that order. So suppose if you put 1.618 retracement of this, which is the trend maturing point, 1.618 times of this, and just add it to the same low. This one added it, because you are saying that no, you have told 8013, but it has gone to something more. What happened during that day? So you can take for the 1.236 also, one more maturing point of the Fibonacci. You can take that also. So proof, this should be proved that what you have expected as per the Fibonacci and what it has given you. So it is not my calculation, rather it is, so it is telling you above 18,083, it should go to 18,288 or 18,620. So you have gone till, you can say, 424 and settle at 384, couple of points just below that. So same way another one cycle should continue. Second cycle you can get, third cycle you can get, but little bit of refining you have to do. What is the need of a refining? Because every day basis your volatility will change. So what was the volatility here on 12th June? Volatility has changed on 22nd June. Same volatility is being again changed on 3rd July. So once the volatility changes, so your deviations will come, and that deviation also will limit little bit of your accuracy level. So almost all our softwares are being empowered with this particular concept. And so what are the things we possess? And we never orphan our traders with those who uh, take our products. So it is our constant endeavor. Every month we used to conduct seminar event to educate you. All your trading queries we used to answer through emails. And our volatility positional tool, this software's positional tool, volatility software's positional tool, and positional option strategy, all these tools is incorporated with this particular concept of our one standard deviation, especially for the option strategy, especially for all positional things. We use that for intraday, since we have more superior concept of volatility, more superior concept of Gann angle and volatility, which has a greater accuracy level. So we have utilized those methods. So these are the 10 different products of smart finance, what is appearing on your screen. Many of you are buyers, many of are the newcomers. If you have a long-term vision to exist in the market, to learn something, enhance your knowledge, sometimes if you want an authentic, scientifically proven software tool, and that to be affordable tool, then you must think about smart finance. So we have 10 different products. So if you take all these products separately, specifically this GAV for intraday and volatility also for intraday as well as short-term trading. So these two products are there. If you go for pair trade and other things, that too also we have specific tools. So in this particular things, if you, it is full packages, those who are buying, they are getting a 6 printed books, near about 18 to 20 DVDs along with all our software. So it is, if you buy separate, it comes to some 47,000. But uh, uh, means if you go for a lump sum package of ours, it comes to 17,000. But I think currently we are running some offer here wherein you can get all our stops at a very reasonable price of only 14,000, I suppose. So Mr. Karthik GA is asking, I'm looking for a capital on constancies and uh, looking for a positional trade in the Nifty options. So Mr. Karthik, for you, option strategy software will be more useful. So, so there little bit of effort you have to put from your end to learn the concept, and little bit of effort we will be putting from our end. So to give you a correct guidance, in that case you can able to uh, make good money. Means so you can achieve your projection of 4 to 5% of profit with excellent risk management. So Mr. Ramesh sir is asking, what is the best software for intraday trade in the Nifty future? Only if you are aiming for, if you are aiming for the Nifty future only, then you can think of our GAV software, Gan Angle with Volatility. That software comes at a price of 3,000 rupees. So this is also software good for your intraday trade. This number for any time, means for any help. So this is flashing in our screen. So thank you very much. Thank you for your time. Wish you a great weekend and wish you a very happy and prosperous trading days ahead. With this, I am ending. Thank you very much. Thank you for your time and thank you for joining this program.